because I think that's really something that a lot of investors have a hard time with, especially newer investors, is the differentiation between a good company and a good stock to invest in.
Well, I mean, it's so hard to tell, like, all right, because you're now pulling at an arbitrary qualitative, idea, or basically a qualitative idea, and saying, oh, this is what's being priced into the stock at this point, right? That is extremely difficult. Like, me and you could BS all day about what we think it might be, but what it actually is we might be completely off.
I'll say this. Sorry, I missed your question there. Small cap core. So the way I do it is we have eclectic value, where I'm looking for really unique value situations. If you go listen to the Value Hive podcast, you'll hear a few of those. And then the other side is disruptive growth. So I take those together, I mix them together, and I have a portfolio that has better than Russell 2000 valuation with better than Russell 2000 growth, which if you look at the S&P style boxes, that puts you in either core, or sometimes they call it balanced. But the idea is really to get the best of both worlds, some value exposure plus some growth exposure.
Very cool. I mean, so give us if you may, I know you mentioned a few examples on the other one, give us maybe an anecdote or an example of one that kind of fits that criteria. Maybe it's a current holding, or maybe one that you already sold. I'd love to hear, people like examples. I like examples,
Everyone loves an example.
Yeah.
I'll give you an example. This one's been killing me. And we did talk a little bit about it on, I think, the Value Have podcast, but it's gotten a lot cheaper since then, so I'll mention it again, is Vertex Energy. So it's been an absolute disaster. Now, it was an interesting situation, and I actually wrote a Seeking Alpha on it years ago. And, I originally bought that thing in the ones, and it ran up to 15, 16. I sold a lot of it in the teens, kind of 12, 13 range. And then I got sucked back in, and when it fell into the 9s and 8s. And then I really started buying it in the 5s and below, and then really started pressing the gas as it's recently fallen in 2024. So that's the type of name that I'm looking for, where I think there's an obvious value event coming, right? So you've got this company, it's got all these different assets. It's very difficult to recreate a refinery, and I dare say near impossible in the US in this environment. Even if you could, it's going to cost you a couple $1 billion. We've got a company that's got about $250 million in debt. They've also got a $100 million inventory financing agreement on top of that. And then they've got a standalone refinery that they've then added on a renewable diesel project to, as well as another refinery and a used motor oil collection business. So if you go through the pieces of this business, it's quite clear that the valuation is much higher than the market gives it credit for. The main diesel refinery, the mobile plant, is insured for more than $1 billion. The market cap is 100 million. The enterprise value is 300 maybe. So that one asset, the insurance company says, is worth at least $1 billion. They're also working on a JV through Bank of America. They've pointed often to the Calumet deal that was done a couple of years ago, also run with Bank of America. And if you start to run the numbers on what Calumet was paid on a price per barrel versus the amount of barrels that Vertex has, you easily get into the $750 billion valuation for a JV. So you've got two different $1 billion pieces on a company that's trading at less than 500 million EV. So the case here is, okay, they've been burning cash as they've put together this renewable diesel part of the business. That is true. And certainly the renewable diesel economics haven't been great this year. I think the real story starts in 2025, though. But I think the real key is we're 6 months or less away from the announcement of a JV that I think brings in $200 to $300 million. And from there, they pay back what they have, which is pretty pernicious debt that they took on before they basically, as they bought this refinery, which was a big coup for them a couple of years ago. So they need to refinance that debt. It yields about 17%. They'll bring in 200, 300 million in cash. There's so much value in those assets. They're almost, I'm not going to say irreplaceable, but they're very hard to recreate in this world, especially in North America.
And I mean, in your opinion, what's the percentage of risk that the company goes defunct before any of these catalysts take hold?
I'm not going to say it's zero, but it's very close to zero, I think. Because worst case scenario, I think people forget this. They also have, so when they bought the mobile facility, they tried to sell both of their used motor oil business and the refineries associated with that. They sold the smaller one. That original deal didn't go through. It was to Safety Clean. They pulled that and then sold the smaller of the refineries on its own for, I believe it was $90 million. Okay, so the other refinery is worth at least 90 million, maybe 150 million plus the UMO business. There's definite interest in that asset. Now that it's not all together, could Safety Clean come back in? Maybe, but there's definitely other interest in that asset. So worst case scenario, they sell this. They still want it because there's some use for it in their new business plan. But if they had to, I think they could peel that off relatively quickly. Now, I really don't think that'll be the issue, especially if crack spreads stay in the $30 range, because they're going to be making money now, and then it's not a cash burn problem. And I do expect that they'll get a JV done. To me, the big question is it, do they give up 25%, 40%, 30%? What's the number that they give up to get $200 to $300 million that then gets them out of their capital problem? And in fact, on the last call, the CEO specifically said, our intent in this JV is to replace the capital we invested into the renewable diesel refiner, which is about $260 million, back on the balance sheet. So we know what he's looking for, 250-ish million bucks. And he said that they expect to have a deal to announce in Q2. So we should be months away.
Very good. All right. And just for full clarification, I know you more or less.
Oh, and yes, I do own it. Frankly, it's a company called ASP Isotopes. So ASPI, ticker symbol, do own it. It's become a big position for us because it's done quite well. But basically, they're it's a really neat business. They basically have two sides of the business. They have medical isotopes, and then they've got a JV that does quantum laser enrichment for uranium. Okay. And the specific end market for that is something called HALEU, which is high assay, low enrichment uranium. And that goes into next generation uranium reactors, specifically the small nuclear modular reactor. Okay. So why is this business interesting to me? This little South African business at that. So what I learned in looking into this business is, to the best of my knowledge, only two countries never signed on to the nuclear proliferation agreement, Saudi Arabia and South Africa. And South Africa had a very strong nuclear research team during the apartheid days. When apartheid ended, that program ended, and those scientists had to go figure something else out. And what they did is they created this technology to do QLE, quantum laser enrichment, but also a new methodology to separate isotopes. Okay, and this new methodology to separate isotopes is effectively cheaper, faster, better, right? Like, cut to the chase. That's the idea of it. And where this becomes really interesting is in medical isotopes. So think like, I can't name it, but ytterbium, I think is what it's called. I might be wrong on the name, I apologize. But there's all sorts of different radioactive medical isotopes, most of which come out of heavy reactors, most of which come out of Russia. Okay, obviously dealing with Russia right now is a no-go. So there's been a massive deficit in supply for these guys. ASP is ramping into that market. And then there's a bunch of other non-medical isotopes, things like specialized silicon that go into quantum chips, et cetera, on that business. So that's a really interesting business. They've got their first sales starting in Q1, and it's ramping aggressively. I think they probably do maybe 10 million, 12 million in sales this year on that business. So that's kind of interesting. And it's like high margins, 80% plus. But the really attractive part here is this QLE. And to the best of my knowledge, there's only really one competitor. It's a company called Silex in Australia. So market cap on Silex is like 800 million plus. They've got a partnership with Cameco. And just the other day, actually, the CFO of Cameco came out and said, I'm going to paraphrase what he said, but paraphrase, Silex is years away from being able to make HALEU. Okay. Whereas Silex can use tailings, but they have to do it in 3 to 4 passes. So one of the issues with this technology is obviously it takes a lot of energy, costs a lot of money to run these things. So you can imagine running it once versus 3 or 4 times is very beneficial to your margins. And then even more than that, effectively they can set up a tolling model, because there's a lot of places that have nuclear waste that want to get rid of it. Well, what better way than you pay someone to get rid of it, ASP, and then they turn around and re-refine it, turn it into a value-added product that gets used to turn around and create energy for people. So QLE is a really interesting JV. They just raised like $25 million in a convertible note through some really well-informed uranium investors in Europe. Tees River coming to mind. They've also done an investment in ASPI. But what I think is just the bee's knees for ASPI is they set up this QLE joint venture. They're going to get a 10% royalty on everything, all the sales that QLE ever does into perpetuity. Plus they get a E&P contract on the building of all their plants. So you got, they just raised $25 million. That's going to plants. So that's going to run through ASP. You get a 25-30% margin on it. So the stock's done really well. I think the market cap is now around 250 million. They've already got revenue. They'll have cash flow this year. The closest competitor is Silex, which is just the QLE JV that ASPI owns 100% of. Now they're going to sell some off. You're talking about 3.5 times valuation disparity between the two. So there's a little bit more to it than that, but that's the high level. And that would be in my world of disruptive growth.